Many of us think that it is possible for us to form some groups and make some investment decisions and live happily ever after. Why go to a mutual fund at all? Assume that a few of you friends came together and decided to invest. There would be key questions that you have to ask. Apart from the fact of what you will select, how you will invest, there is the operational question of in whose account will those securities lie. If you bought shares, if you bought bonds, they have to be credited to somebody's demat account. And this bank account will also receive the dividends, the capital gains. And tax authorities are going to ask your friend who is managing your money to pay taxes on them. So it might not be a great idea because he's going to pay tax on all those capital gains, all those dividends, all those interests that he receives. Then you agree on a formula for sharing and he sends that money over to you, he credits all your accounts. So the income comes into all your accounts and gets taxed again. Cruel. The same income gets taxed twice if you formed such a friendly group for investing. So if you think it's a good idea for one expert to make these investment decisions on your behalf and run your money for you, going to a mutual fund might be a better idea. Because the Income Tax Act specifically recognizes the mutual fund as a pass-through entity. What is a pass-through entity in income tax? The income earned by the mutual fund is not considered its own income. It is the income of the investors in the mutual fund. So the mutual fund itself pays no tax. It receives these income and passes it over to its investors. For it to be recognized as a pass-through entity, it needs to be a SEBI registered mutual fund. So once a mutual fund is formally set up, it is approved by SEBI and it is in business. Whenever you invest your money through such a structure, the experts make your decisions for you and they pass on the income to you without this income being taxed twice. That is the tax attractiveness of the mutual fund structure. So how does this mutual fund help you further in the way in which your tax is structured? Most mutual funds in India offer you two options, a dividend option and a growth option. The dividend reinvestment is not really a separate tax structure, it is just a variation of the dividend option. So primarily you have a dividend option and you have a growth option. In a dividend option, you can receive your income in the form of dividend. So in your tax books, this income is a dividend income. If you chose a growth option, in your books, you will primarily receive capital gains. And these capital gains will arise only when you sell the units that you're holding. Under the tax laws, the treatment for dividend and the treatment for capital gains are different. So the fund itself does not run multiple portfolios, and there are several investors who think the return from a dividend option is higher than the return from a growth option. These are not true. The fund manager will run only one portfolio. It is your post-tax return that can be different. So the fund would run the portfolio, declare the NAV, and this NAV will be different for the dividend option and for the growth option because the dividend option keeps paying out the money to you as dividend, the growth option continues to accumulate. So the choice you have as a taxpayer is to decide whether you want to choose a dividend option or you want to go for a growth option. You have a benefit by using a mutual fund for your investment purposes. When it comes to income and its taxation, there is a lot that depends on what is the kind of structure you are. Are you an individual? Are you a HUF? Are you an NRI? Are you an independent business? Are you an association, an educational trust? So many of the tax rules that apply in terms of what will be the taxation of dividend, what will be the set off on capital gains, what will be the benefit that you will get, is this business income, is this subject to indexation? These are multiple questions whose answers are not standard. A lot of these interpretations will really depend on how your tax and your books for income primarily look like. So while you should use some of these information on what is the taxability, you must always consult your chartered accountant to understand what your exact liabilities would be. None of these standard statements that work for a mutual fund should be taken as completely applying to you without taking into account what your specific tax status is.